Loan officers who said, we've already priced in these LLPAs, they're not going anywhere, move on to something else. Well, I want to tell you, LLPA's changes might have met their match, and in part that's because of you. And also, Chase, JPMorgan Chase, they got even bigger.
Are you sure about that?
That and more in the National Real Estate Post. But first, I want to let you know that Listing Booster as a product where realtors and lenders work together has completely changed. It's been reskinned, got new technology, it's integrated artificial intelligence, so it'll give you recipes too, and it's the easiest surefire way for loan officers to work with real estate agents, garnering a larger piece of the pie in an ever-shrinking market. You want to check this out. Let us show you. All you have to do is click this banner right over there, and we will give you a demo onto the show. Last week, Patrick McHenry of the House Committee on Financial Services and Warren Davidson, the chairman of Housing and Insurance of the Housing Committee on Financial Services, that's a title, both of the House of Representatives, just sent a letter to the FHFA Director Sandra Thompson expressing disapproval on the Fannie Mae and Freddie Mac loan level price adjustments, along with the belief of long-term negative ramifications on our economy because of these changes.
Top finance officials from 27 states on Monday urged President Biden to end what they said was his unconscionable policy of forcing people with good credit scores to subsidize mortgage loans of higher-risk borrowers, and warned Biden's plan would be a disaster. Now, we explained this point to you last week. So, question, can President Biden just arbitrarily end the madness of the recent implemented loan level pricing adjustments?
But back to Biden, can he change this? And the answer is yes, he can actually change this and do it right now if he chose to.
I'm going to be fine with your jokes, but I'm not sure about Dark Brandon.
He can do so without congressional approval because these changes were made without congressional consent. You see, Director Sandra Thompson serves at the pleasure of the principal, was appointed by his simple decree, and can be axed without cause. And you see, the more noise that we all make, the better. And there's nobody better at making noise than a bunch of real estate agents and lenders. Come on, you gotta admit it's kind of true. Let's call our reps, let's call our senators, and sign the stinking petition to reverse these LLPAs. It's madness, I tell you.
This just in. A couple of days ago, Chase bailed out First Republic Bank by purchasing their smoldering remnants, a move that made Chase even bigger. And if you're following the logic here, too even bigger to fail.
You know, I was thinking about this though, it's really kind of a perfect fit because Chase knows something about being bailed out, don't they? On August 28, 2008, Chase took a $25 billion bailout from us taxpayers. And on that very same day in August of 2008,
Wells Fargo, State Street Corp, B of A, Citigroup, Morgan Stanley, Goldman, and the Bank of New York Mellon all took bailouts in what ultimately amounted to more than $1 trillion in loans and hundreds of billions of dollars of capital and guarantees flowing to financial institutions.
And just yesterday, in early trading, stocks got walloped as investors show concern about bank health and more failures to come. And by the way, if you want to see Eric Bowlby's thoughts on why banks are really suffering right now and what the future holds, there's a deeper dive down below. It's about 45 minutes, but it's very illuminating. But I want to ask you guys, whatever happened to Too Big to Fail? Now, I bet you didn't know this. I really bet you didn't. It was repealed. See, after the trillions spent, we can't have banks that are too big to fail. Well, then we're on the hook as taxpayers, right? But banks just got bigger, didn't they? Since 2008 to now, we have fewer larger institutions, just like Chase got bigger a couple of days ago when they bailed out First Republic, right? They assumed all their assets, and the government looked at the results of their actions and said, maybe we just let all these mergers kind of slide and allow banks to get even bigger in spite of what their laws were on the books. And they did, emphatically.
Now, back in March of 2016, from the Government Accountability Office titled Ending Too Big to Fail, large banks are now considered safer because the expectations about government bailouts have shifted.
That's right, it has shifted since 2016, and it seems the government is in favor of banks being bigger. In fact, one analyst raised the possibility that if the nation were back where it was 8 years ago, remember this is from 2016, so this goes back to 2008, and we were in the throes of a financial crisis like right now, big banks would again see lower rates relative to smaller banks like right now. That is, it is possible that they would reap the benefit of being too big to fail when it matters most. Isn't that interesting? This came from 2016. Man, did they have a crystal ball. And well, the much smaller first republics of the world, they just fail, much to the benefit of the now ever increasing size of the big banks and the, JPMorgan Chases of the world. And I want to make this really clear, especially during these times of musical chairs in the mortgage space and the real estate space, a lot of people's emails have gone the way of their old employer. So when you forward this show, you help us perpetuate the brand, the product, and the opportunity for us to bring you great content on a regular basis. So do us a favor, share this, forward this, and advocate because it helps us out.
Seriously, like, share, and subscribe. I know you guys are tired of hearing about it, but it really does make a difference to a small business like ours that's just trying to deliver you some news in a positive way.
Thanks, guys.